Welcome to the Retail Focus Podcast, a weekly collection of news, interviews, and information from the world of retail.
Welcome to this edition of the Retail Focus Podcast. I'm Trent Kling. Coming up on today's episode, we'll be joined by Jennifer Moretti, the Senior VP and Chief Activation Officer at Washington Prime Group. Jennifer will join us to discuss some of Washington Prime Group's initiatives recently. Of course, Washington Prime Group, a fairly large retail REIT with around 100 properties in the United States, town center type properties, if you will. So a lot of great insight coming from her later on in the show. We'll also talk about JOANN and JOANN's potential IPO coming up after news broke this week that their private equity firm is eyeing such a thing. And in our news segment, of course, Walmart released earnings. We're going to look beyond just the numbers at some of their initiatives and how those initiatives are sticking as they turn into a new fiscal year. A reminder that you can subscribe to us or rate us, of course, on any podcast listening service. However you're listening to us today, if you enjoy this show, please give us a rating. It helps others to find us. Additionally, you can check us out on social media at Retail Podcast. So no further ado, let's get into it. Retail titan Walmart, as I mentioned, released their year-end report, Q4 earnings, and next fiscal year outlook all this week, in fact, Thursday of this past week. And although e-commerce continued to surge for them in their last quarter, we did see a slowing of sales growth in grocery, talking about Q3 here, and that was of particular note. We talked about it on the podcast. The company mentioned during their last call they anticipated continued slowing of growth in grocery during the fourth quarter, and it was against that backdrop that we got their latest numbers. So on to the Q4 or year-end numbers. Overall net sales did increase company-wide by 7.4% in the fourth quarter. Operating income went up by 3.1%. And that's throughout the entire company. But as we've referenced before, we're more interested in U.S. sales and performance than the performance of their entire company, especially since they'll be divesting 3 entire other countries' worth of operations off, which we'll talk about here in a second. Their U.S. stores did slightly outperform the rest of their portfolio as a whole, with U.S. net sales up 7.9% in the fourth quarter, ended up setting an all-time record for U.S. sales coming in from their stores. Comp sales were up 8.6%, excluding fuel. That's a very solid holiday season, and for what it is worth, pretty solid sequentially coming off of that backdrop, as I mentioned, in Q3, where we saw some of that slowing of growth. Walmart did, however, buck the trend that we've seen from other retailers, where the gap between transaction growth and ticket growth year over year had kind of narrowed as the pandemic continues. More people are going for more frequent trips. They're not stocking up quite as much as we saw on the outset of the pandemic. But Walmart saw comp transactions, the number of transactions, down 10.9%. Average ticket, though, up 21.9%. And you can say, however you experience growth, it's still growth. But kind of curious here, when others such as Target are seeing slight growth in transactions and traffic, people are making more frequent trips. And I'm not saying this is necessarily a bad thing for Walmart. Certainly, it's a great thing that average ticket is up 21.9% if you're a Walmart executive. But it is interesting that people are consolidating trips to Walmart, where we're seeing them not do quite as much of that now with other retailers. That noted, Walmart did say transaction volume did see an uptick somewhat when store hours were extended for a lot of locations in November in the lead up to the holiday season. Now, e-commerce once again saw the robust year-over-year growth we've come to expect, pandemic or otherwise, from Walmart, up 69% year-over-year for e-commerce sales, contributing 620 basis points to comp sales, meaning in-store comp sales were still up, excluding those e-commerce impacts, excluding orders that touch the digital channel. Store pickup and local delivery both saw triple-digit increases, as did their marketplace sales through third parties, and that important to the company because it increases their margins when they sell their marketplace goods or sell those marketplace goods from third parties. Now, we began the story by noting their attenuated optimism somewhat, Walmart's attenuated optimism surrounding grocery sales. But grocery sales at Walmart US indeed increased by high single digits in the quarter. This was better than the company expected, and they said this was due largely to 3 overarching themes: expanded hours, more in-stocks, and pricing models. Of course, later on in the week, to some media outlets, Doug McMillon talked about the fact that you're also seeing stimulus checks being spent on things in that grocery segment. But again, for them, they're looking at expanded hours, being able to have more items in stock and on the shelves inventory-wise, and then their optimal pricing model. So basically, decrease in terms of promotional activity, ideal pricing there, making sure that they're lower than most other retailers, but squeezing out as many margins as they can on that front. Now, in terms of subcategories in grocery that drove performance, household chemicals and paper products. Those are the same two things that have been driving sales in this category for some time for them. No change in Q4 on that. Health and wellness did backtrack somewhat to mid-single digit growth. This is mostly from pharmacy comp sales increases. Good news on the pharmacy front, but it was offset by softness in optical as a result of more stringent regulations imposed by most of the country as COVID spikes occurred in late November, during December, and early January. You saw a lot of regions, including where I live here in Colorado, kind of scale back what was possible for medical providers. That, of course, impacted Walmart negatively on the health and wellness front. General merchandise, meanwhile, picked up the rear, still increasing, but just by low single digits. And again, in this circumstance, it wasn't all about merchandise not flying off the shelves, because there are other things lumped into the general merchandise category, specifically auto care centers, providing some headwinds here because of the fact that not all are fully operational yet, coming off of the pandemic. We're not out of the pandemic, of course, but they're starting to reopen those auto care centers. Still, the fact that they're anniversarying a quarter four of last year, where all of them were open and servicing vehicles, especially during the cold winter season, that didn't help matters. But certain categories were high performers for them. They called out a lot in this category as far as shelf goods, comfort, leisure, recreation, electronics, sporting goods, toys, outdoor living, all seeing strong sales. And this category, Walmart said, seemed to benefit the most from those early year stimulus checks. Not necessarily that people were going and spending them on TVs or luxury items, but that they were purchasing maybe some products that they had put off for the house prior to those stimulus checks coming in. Now, other trends to note for Walmart USA specifically, they saw gross profit rate increase slightly by 20 basis points. Specifically here, they mentioned e-com margin improvement stemming from the increase we talked about in marketplace sales and supply chain synergies, being able to mobilize and use local stores and local distribution centers for fulfillment. They also saw significant benefit from sourcing initiatives and, as we mentioned earlier, but as almost every retailer has been noting, fewer markdowns. We are in a circumstance now where, especially general merchandise, grocery, you're not seeing as many markdowns from retailers across the board. And that's whether you're a specialty retailer like, say, Bath & Body Works, or if you're another general merchandise retailer like Target or even the likes of a Dollar General, you're not seeing the same markdowns that you were seeing 1 year ago. Now, their operating expense rate was negatively impacted by about $900 million in incremental COVID costs. Of this, the vast amount, by vast amount, I mean over 90%, went to bonuses and benefits for employees. Walmart, by the way, also mentioned their efforts to keep pace with those increasing sales on the buying end of things. And so they continue to try to chip away at out of stocks. And I mentioned grocery sales being up high single digits for them, in part because they're in a better place inventory-wise. And comp store inventory, they said for them, rose 1.1% in the quarter. So that's, again, the amount of inventory in a particular Walmart store on average went up by 1.1%. But something that we found very interesting is that their overall inventory, which includes both comp store inventory and fulfillment center inventory and DC inventory, rose 7.1%. So they are really scaling up in terms of inventory intended for online fulfillment. And here we're not talking about the store fulfillment. Here we're talking about fulfillment directly from one of Walmart's centers rather than from the store. Now, the inventory increase did improve in-stock levels. And the reason I say that, it sounds sensible, right? If inventory goes up, in-stocks go up. But in Walmart's case, they made it a point to say, hey, this inventory increase, it's not just us stockpiling items that are already in stock. It is us actually getting items in stock that were previously out of stock. So as a result, in stocks are higher, sales are higher, and more people adding to the total amount in their cart as a result of things. So it's really a domino effect here for Walmart, and it's not, again, just a matter of saying, hey, we've got 5 of item X in stock, let's carry 10 instead. It's a matter of saying, hey, we've got 0 of item X in stock, but our buyers were able to find 5 so we can put something on the store shelves. And I wanted to finish in terms of looking back at Q4 for Walmart as a company by looking at Sam's Club. And you could make an argument that maybe we buried the lead here, and I wouldn't necessarily disagree with you. Net sales at Sam's Club rose 8.1% across their store chain. Comp sales up 8.5%. So maybe a little bit behind what you've been seeing from Costco over the past couple of months. Good strength here at Sam's Club across multiple categories, food and consumables among them. Now, tobacco did have a negative impact. When you take tobacco out, you're really looking at the teens in terms of comp sales. Comp sales overall helped by e-commerce net sales growth of 42%. Not as much as Walmart, but still pretty substantial. But here is the outstanding figure if you're a fan of Sam's Club or if you're a member of the Walmart C-Suite. Membership income for Q4 up 12.9%. And this comes from a number of different factors. Increase in total number of members. New member count increased by approximately 28%. Overall renewal rates went up, plus renewal rates. So again, you're talking about that next level membership, so to speak, plus penetration rate also up. This, to put it in perspective, this increase in membership income for Sam's Club was their highest quarterly increase in more than 6 years. And that tells you that they are driving traffic. They are taking advantage of the pandemic. They are taking advantage of this continued effort by consumers to make fewer store trips and to stockpile while they're at the store. Makes sense that Costco and BJ's and Sam's would all benefit from it. But here, to see the membership income increase, it's a very good sign, not only for the fourth quarter for Sam's, but for the year ahead. And again, when you take out tobacco sales for Sam's Club and you take out fuel for Sam's Club, you're looking at nearly mid-double digits or mid-teens in terms of comp sales, right around 14.9% going up. Comp transactions also up at Sam's Club as a result of those new members, up 8.4%. Interestingly, average ticket only jumped 2.2%, so it's really a matter of more people buying into the Sam's Club concept and getting to the club than it is the people that were already going buying more. Breakdown of categories real quick for Sam's Club. Grocery and beverage up high teens year over year. Fresh freezer and cooler up high teens year over year. So again, grocery killing it. Consumables up in the lower 20% range. Home and apparel up high single digit. So they're seeing success in areas that not all retailers are actually seeing success in. And I think what's interesting is you're starting to see this backing off a little bit of technology purchases by consumers at Sam's Club, because remember, we were talking about increases across the board at many different retailers as people attempted to acquire work from home technology and learn from home technology for schools. Instead, technology, office, and entertainment was down low double digits at Sam's. So just something to maybe keep in mind here is that overall, you're seeing some slowing of growth there. And Sam's did say personal electronics, TVs did pretty well, offset by reduced mobile phone sales. Still, electronics, TVs, office furniture, not up quite as much as they had been in previous quarters. So just a few things to keep in mind there regarding Sam's Club, but a really strong quarter. Love to see those membership numbers going up, and you know that could portend great things for Sam's Club in the next year. Speaking of the next fiscal year, well, again, Walmart's one ahead in fiscal year. So their outlook released during this presentation this week covers fiscal year 2022 for them. One major facet to keep in mind for the coming year is the divestiture of a few of their international divisions. As I talked about, you're looking at 3 divestitures overall. As such, consolidated net sales, they're actually expected to decline throughout Walmart year over year. Just keep this in mind when you see the Chicken Little headlines over the next 12 months about Walmart's falling revenues, likely going to be because of these divestitures rather than any failings as far as the stores that they are keeping under their umbrella. Adjusted net sales excluding divestitures are expected to rise in the low single-digit range because of some of the great quarters from fiscal year 2021 that they'll be lapping. Now, divestitures overall, when I talk about this includes their Argentina division. That took place in November of last year. The UK this month of this year. Japan sometime also in the first quarter of fiscal year 2022. So pretty significant when taken as a whole. Now, in terms of comp sales growth in the U.S., you're looking at Walmart U.S., Sam's Club expectations growing by low single digits in lockstep with adjusted net sales, and that excludes fuel and for Sam's excludes tobacco. Honestly, probably at the lower end of what some analysts might be thinking, but again, you're looking at Walmart lapping some really, really nice quarters, especially surrounding really March through June when they were the only retailer in certain areas that had stayed open during the first portion of the pandemic. Also, it makes sense that their comps will be moving in lockstep with adjusted net sales because their net store openings have been at or around zero for the last several quarters. Very definition of a mature retailer, but also one that's funneling most of their efforts into augmenting existing stores rather than expanding their footprint. Operating income, they said they expect to increase slightly. Didn't put a percentage estimate here, although strengthening of their margins in late 2020, taking that into account, one could see a potential for low single-digit percentage increases here based on their expected sales increases. They did note that they expect their international divisions, the ones they're keeping under their umbrella, to see a higher growth percentage than in the U.S. when adjusting for those sell-offs. However, this is going to be a decline on a constant currency basis, really something that Walmart doesn't have any control over. Finally, CapEx for Walmart, they expect to come in at $14 billion. The spending, no surprise to anyone, it's going to be in automation, supply chain, and technology. You're not going to see a whole lot of new Walmart stores under construction for fiscal year 2022. Well, that'll do it for the news segment of the podcast. Coming up after this break, we'll be joined by Jennifer Moretti, once again Senior VP and Chief Activation Officer at Washington Prime Group. She will join us to discuss some of Washington Prime Group's most recent initiatives at certain town centers throughout the U.S. She's also going to talk about how Washington Prime Group decides to roll these initiatives out in those given areas and in the areas they serve throughout the U.S. I don't need to tell anyone listening to this podcast that the scope of shopping centers has changed considerably in the past decade, from indoor malls transforming into entertainment destinations, the rise of outdoor mixed-use developments, and, of course, the pandemic over the last year. This space has seen an interesting last 10 years, to say the least, and perhaps no company embodies the MO of constant retail real estate innovation like Washington Prime Group. WPG holds a variety of properties and town centers all throughout the U.S., and joining us to discuss a few of Washington Prime Group's recent initiatives is Jennifer Moretti, the Senior VP Chief Activation Officer for Washington Prime Group. Jennifer, thank you so much for joining us today.
Hi, Trent. Thanks so much for having me.
First, and I know we've talked about the company a little bit on the podcast before, but for our listeners that might be a little less real estate centric, I was wondering if you could discuss a bit about Washington Prime Group, where you have a presence, and the overall scope of your operations for us.
Sure, I'd be happy to. So let me first start by sharing Washington Prime Group is a retail REIT, so a real estate investment trust company, and we are the recognized leader in the ownership, management, acquisition, and development of retail properties. We combine a national real estate portfolio with expertise across the entire shopping center sector to increase cash flow through rigorous management of assets and provide new opportunities to retailers looking for growth throughout the U.S. We have approximately 100 town centers throughout the United States, and we like to consider ourselves as American as apple pie. Our well-regarded infrastructure from Hawaii to Connecticut and pretty much everywhere else in between allows our tenants and our sponsors and our partners to benefit from the operating efficacy and economies of scale at a large national real estate company, alongside local management who possess comprehensive knowledge of the locale within the areas that they reside. We're the dominant player in the secondary catchment areas.
And so I want to tie that in because you mentioned obviously you've got the economies of scale, over 100 town centers throughout the U.S., but you also have local management. And that's going to tie into the first thing I wanted to talk about today because you've got this new initiative called Tangible, very much ties in with that local aspect, with the small business aspect that's so important to Washington Prime Group's operations. What is Tangible and where throughout the country is the initiative launched so far?
So Tangible is Washington Prime Group's exclusive e-commerce showcase, which curates online digitally native purveyors on a rotational basis, allowing for a really dynamic treasure hunt experience. Tangible is currently located in Columbus, Ohio, Tampa, and Outlet Collection at Seattle on the West Coast.
So you mentioned it's kind of a rotating, curated collection. What are some of the turns like, and how often or how long might a certain product or a certain brand be on the shelves there?
So from a rotational basis, we like to constantly launch new brands and new products. So typically our rotations or new product introductions are anywhere from 3, 6, 9 months. And I think what's really important to us is that we're offering a broad range of very unique brands and products that you wouldn't necessarily find in our town centers, and that we're able to offer our guests the opportunity to really touch, feel, experience before committing to a purchase.
Now, of course, as we've kind of talked about, there's an emphasis here within Tangible on startups and local products. And I was curious if you wouldn't mind sharing some of the more notable brands, or maybe specifically even brand stories or stories behind brands that have a presence within Tangible currently.
Yeah, I'd be happy to. I think a few of them, and most recently that are in the collective, we have For All Cares. For All Cares is our first CBD brand. The company creates really lush products, carefully crafted with CBD to provide rejuvenation and restoration from head to toe. So I think what was really important to us in this partnership is about wellness and offering our guests a really unique product that they can enjoy. Chassis is a Bronx-based New York company, currently online only, but they create really unique desks through partnering with other New York City-based artists. And I think with the trend in hybrid remote working, that was something that we were really interested in offering our customers. And then Black Box is a really exciting subscription that serves curated products from Black-owned businesses. They're based out of Phoenix, Arizona. And we launched this brand during Black History Month in 2019. That's when they went into really curating their brand. And we were really, really interested to highlight them most recently in Tangible. They are very community focused, all about giving back. And we think that really aligns to our values of Tangible being so community focused.
Now, this is a massive and fairly large initiative, even though we talked about somewhat limited as yet in terms of number of locations. You just mentioned it in your last answer. You're talking with brands from Phoenix, you're talking with brands from New York, all across the country, really. So I'm curious as to what some of maybe the operational hurdles were as you were putting together the Tangible concept and beginning to roll these out to the properties.
Well, I think with anything new, there's always challenges, and thinking about what would be the right mix of products to offer our guests. But for us, it was really about identifying those from a relationship perspective and aligning them to our values that we wanted to bring them to our town centers. I think for us, it was really being selective in regards to offering that broad range of products and brands. So there's something for everybody. We don't want to get too distorted into one category or overpitched in another. For us, it's really about continuing to source and procure that broad range. So we have things for men and women and children and gifting. And I think it's just really important that we don't get too distorted into one category.
I'm curious what that process is like and what the process is behind a brand being featured within Tangible from maybe the start of the conversation all the way through to the final execution.
Sure. When we do our initial outreach, we definitely look at brands that we believe would be a good fit for Tangible. And that conversation is very introductory. We want to share with these prospects our centers, the trade areas, the opportunity to gain real thoughtful brand awareness and reach. And we talk to them really about our value proposition and how we are situated in these catchment areas, what the opportunity that they have to create brand awareness and offer their products in a physical showcase that they traditionally would not have the opportunity to, because most are digitally native. So the conversation is really about relationship first, bringing new and exciting products to markets that could be a great fit to provide brand exposure. And then from there, we really talk about what those terms could look like, from how many months, what are opportunities to integrate physical activations to showcase their unique offerings, whether that's sampling, whether that's event integration. But I think for us, we want it to be a very comprehensive experience and have our brands fully integrated into our assets.
So we talk about sampling, we talk about perhaps events and presentations surrounding this. I'm curious as far as what customer response has been at these centers where Tangible is located.
The customer response has been very positive. I think we hear from shoppers constantly that they appreciate the ability to try before they commit to a purchase. And I think that's really the brilliance of Tangible. They get to see, they get to touch, they get to experience the products firsthand, that they wouldn't necessarily have that experience just shopping online or on somebody's website. So I think that the customers really enjoy the aspect of that tactile sensory experience prior to committing to the purchase. I think the other thing is they really love the constant rotation, and we're always inviting them to come back to see and experience what's next, given we have a constant rotation and are always launching new brands and new products.
Outside of acknowledging, of course, that the products themselves will rotate through in the future, I'm curious what's next for Tangible and what are some things you're eyeing as far as, if not expansion of the concept, maybe refining the concept overall?
Yeah, that's a great question. I think that we're always looking to improve and refine our current concept. Tangible was really birthed as a beta test. We always have our eye on scale and expansion. But I think for us, it's continuing to identify the right mix of goods and products to offer to our clientele. But we are always looking to really align ourselves with community-centric partners that align with our values and local entrepreneur, small business owners, and really pay homage to them and support their efforts. So we always have scale on mind, but in the here and now, it's really about being selective in regards to the brands and the products that we set forth.
Speaking of scale, and this provides a perfect segue into the next concept I wanted to talk about, which is Shelby's. A press release came out earlier this month talking about the expansion of this concept and the scaling up gradually of this concept. Just a couple of months ago, we spoke on the show to an executive for a confectionery brand about the state of confectionery retail, how specialization is becoming crucial. Shelby's certainly fits that bill. I was wondering if you could tell our audience a bit about Shelby's and what's kind of spurring this expansion and upscaling of the concept throughout Washington Prime Group's properties.
Shelby's Sugar Shop is a sweet curation from WPG. It really presents a colorful, curious, and dynamic environment, sure to delight children and adults alike. We initially launched Shelby's in 2017, and we offer a curated collection of treats, including nostalgic candies, craft sweets, and delicious chocolates, as well as branded create your own collection for a truly dynamic, what we call a really sweet experience. In addition to that, we have unique specialty products and beverages and scented collections. So for us, Shelby really captures adventure. Shelby herself is very spirited. She enjoys the sweet parts of life, which are travel and discovery. And we really want to offer our guests goods and services and amenities that they wouldn't necessarily always find throughout the centers that we are currently in. And the exciting part of our expansion is we are taking our Shelby Sugar Shop traditional inline formats, and we have redesigned and have created a more common area-centric retail unit that is smaller in square footage, which allows us to drive density from an assortment perspective and drive, I would say, even greater levels of productivity. And our thought process with that is to integrate it into our common areas and be able to activate and integrate Shelby's within our very robust property event cadence. So currently we have 5 inline stores and we are expanding our footprint by 4 in Columbus, in Tampa, Colorado, New Mexico, as well as Outlet Collection Seattle and the mall at Fairfield Commons in Ohio. So we're really excited about the expansion and, looking forward to delight our guests of all ages.
You kind of mentioned the difference between inline and common area stores or common area locations and trying to assess where exactly to place a certain concept so it provides that perfect confluence of both driving customer traffic and also ensuring that customer needs are taken care of when people visit these properties. I'm just kind of curious as far as the overall thought process behind expansion of concepts in general behind your portfolio, some of the research that goes into it and trying to figure out where, not just in terms of each shopping center, but where in the country is best to place some of these.
Great question. So we work very collaboratively across the organization, both from a qualitative and quantitative standpoint, and engage with our analytics team to do a deep dive research in regards to where this concept, either where there's white space or where we think it's a great fit, as well as our specialty leasing and property management partners on identifying and really finalizing those asset selections, and then understanding from a location perspective, where are the more optimal locations, high traffic common areas to really install them. So it's a highly collaborative effort amongst some of our corporate partners from a data analytics perspective, and then leasing, and then of course, really partnering with our local property management teams on the overall final placement and installation. They've been obviously great partners in helping us bring this concept to life, and really excited about the partnership. So lots of due diligence goes into selection of the asset and location.
I want to finish up here by pulling way back because you mentioned it. You've got all of this data, all of these analytics at your disposal here. And of course, we hear analysts say one thing or another about retail properties in general and retail real estate in general. But looking through your lens and the information that you have at your disposal, what do you foresee the next 24 months being like just in general regarding your town centers and regarding retail real estate properties in general?
Well, I think that the pandemic fostered innovation. And I think that that is at our core from a WPG perspective. We've recently launched a new website that we have deemed Experience Retail. And I think it's a great showcase that highlights all of our initiatives. And I think it really demonstrates our core competencies and how we think differently than our peers. Located on our WashingtonPrimeGroup.com home website, and we have an innovation tab. And that is how people can access it. But it really walks through how we've adapted in the state of COVID. It has videos, it has tons of great photography that really captures the secret sauce of our properties. And it demonstrates capabilities across design and social and digital and construction and how we bring all of these ideas to life at scale. So I think it really captures kind of the core of who we are. And it's a great reference for individuals that might not know us as intimately. I think in terms of what's next, we're going to continue to iterate on some of these retail brands and the concepts that we offer. But I also think that we are going to continue to connect physical retail and e-commerce to provide guests a really convenient way to shop. One of the programs that we launched during the pandemic was Retail to Go, which really offers convenience based off of how a guest wants to interact and shop within the property. So I think for us, it's really about understanding our demographic constituents, what's important to them, what they're looking for. And then our responsibility is to continuously provide new and differentiated experiences, goods and services, and, understanding what we can do to provide a really high level of service. I think safety is going to continue to be paramount. And I think our teams have done an exceptional job during COVID, and health and safety will continue forward. So I think it's really a combination of iterating on the things that we do really well at our core, which is innovation. And if there's white space, we will seize it or we will create it to fill it. But I do think that it's continuing to get to know our customers and our communities and what they are looking for, and how can we continue to adapt to create the gathering place and the town center within our communities. And I think our teams have showed up in multiple ways throughout the pandemic and leveraging our assets as a community resource and a hub. And we're going to continue to do so.
Well, some great insight, not only into the inner workings of Washington Prime Group, but also these initiatives that are spreading throughout the country. Once again, Jennifer Moretti, thank you for joining us today.
Thanks so much, Trent. I really appreciated the opportunity, and it was great to speak with you. So thanks again.
As always, we may have a position in or against companies we discuss on the podcast. Do not invest in stocks solely on the input of the podcast hosts.
Many thanks to Jennifer for joining us. Always a good time, at least for us on the podcast, when we talk retail real estate. In our Looking Ahead segment, as I teased in the beginning, we're going to be talking about JOANN. JOANN released a prospectus, or rather Leonard Green and Partners, which is their private equity firm that owns them, filed a prospectus for JOANN's IPO this past week. That prospectus noted that JOANN saw a 24.3% increase in sales during the 9 months ending October 31st, 2020. JOANN in a unique position due to the pandemic. A lot of people buying fabric, which is, of course, one of the things that JOANN is most known for. And there's a lot of different reasons we could look ahead here. For one, it's going to give us an additional data point in terms of the arts and crafts retail space. Michael's, of course, a publicly traded company. We know Hobby Lobby keeps their cards very close to the vest when it comes to financials. But overall, you're seeing JOANN just see a massive surge in sales, not just because of fabric for people making masks and the like. People had a little bit more time on their hands. They weren't going out as much. As a result, they picked up on some home hobbies. They were crafting. They were doing all of the things that made Michael's sales go up, in other words. And I think this is going to be really interesting in terms of where the IPO is going to come in and what's going to happen once that IPO launches. Of course, for us personally, we're just happy to be able to take a look at the financials, be on the earnings calls, and so forth. But of course, you've got to applaud JOANN and the work that they've done really over the last 12 to 15 months to be in this position to be a solution for those that are turning their minds towards crafting, for those that are picking up hobbies. And overall, you're looking at a store or a retailer that's tried a lot of different things over the last couple of years, tried different interactive studios, interactive classes. And that's something that, going back to Hobby Lobby and Michael's stores, back even in the 90s and 2000s, it was very, very common there. Some of those retailers have kind of gotten away from that. JOANN's has driven back into that over the last couple of years. I think this is going to be an interesting next few months from them because we're going to get a look at their financials, but also IPOs have been and have a history of being somewhat interesting for retailers. Sometimes you have an IPO that pretty much goes without incident, like Albertsons, for example, after so many false starts there. Sometimes you have an IPO where the stock swings wildly, and of course, as we've seen over the last month or so, stock market valuation doesn't always have the best connection to how a retailer is doing in real life. But a lot of interesting facets here. So interested to get an idea of the inner workings at JOANN, some of their initiatives that they've got planned. They've tried a lot of different things over the last few years in pilot format. Interesting to see if they retrofit store or seek to expand those as well. And we'll get news on all of that. And as we get it, of course, we'll be sure to pass it along. Well, that'll do it for this edition of the Retail Focus podcast. Coming up next week, we'll have an interview with Brittany Furrow. We're very excited to have Brittany on, and this is something that we've been working on now for a couple of months. But Brittany heads up the Health and Sustainability Program at Ahold Delhaize USA. She's going to join us to discuss a little bit about their sustainability commitments they just rolled out this month, about the overall health and sustainability program there, and why it's important to maintain those types of programs as a grocer. Ahold Delhaize, if you're listening to the podcast, you probably know who they are. Usually, most of their stores based on the East Coast, but you got the likes of Stop & Shop and Food Lion all under their banner. So looking very much forward to talking to Brittany next week. Also, here in a couple of weeks, we're going to interview a former CEO at Sephora about mall-based retail, how it's changed, how it will continue to change over the next couple of years. So just some dynamite interview guests coming up for you. I hope you, again, hit that subscribe button if you haven't already, and we'll be looking forward to being back with you 7 days from now.
This has been the Retail Focus Podcast. For more, visit our website at retailfocuspodcast.com and subscribe on iTunes or Stitcher. Follow us on Twitter at Retail Podcast.